You're watching Silver News Daily. Subscribe for more.
The CPI, Consumer Price Index, doesn't include tax. The largest single living expense for most American households is tax. Now, you know me well enough to know, Andy, if I didn't have to pay the tax, I probably wouldn't bitch quite so much about the index. But that's not on offer. And it's important for your listeners to recognize, on the one hand, $130 trillion in liabilities, which is to say the credit quality of the debtor is not as good as you might believe. And at the same time, to realize that real interest rates are decidedly negative.
The dollar's bleeding value, and the cracks are widening by the day. Behind closed doors, the BRICS nations are dumping U.S. treasuries like they're radioactive, and what used to be the most trusted currency on Earth is now facing a coordinated global rejection. But here's what no one's talking about. While the dollar burns, physical silver is quietly vanishing from the market. Vaults are emptying, premiums are spiking, and demand is exploding. Rick Rule says we're looking at a 75% devaluation of the dollar, just like in the 1970s. But this time, America's not just printing money. It's staring down $130 trillion in unfunded promises and negative real interest rates. The Fed can't raise rates without crashing the economy, and it can't cut them without setting inflation on fire. Either way, confidence in the currency is dying, and silver is rising from the ashes. But this isn't just another precious metal rally. It's a full-blown monetary revolt. Central banks are hoarding gold, investors are scrambling into bullion, and the silver shortage is becoming so severe that even seasoned metals dealers can't fill orders without delay. What happens when the public wakes up? When panic buying kicks in and physical silver is nowhere to be found? This isn't a warning. It's a countdown. And when it hits zero, $500 silver may not be a fantasy. It might be the new floor.
I think the government does do their best to control credit markets. It's interesting to me that the Fed and the executive are doing all they can to bring interest rates down. They've been pretty successful on the short end of the trade. And I need to say, I own 2-year treasuries. I'm maintaining a lot of liquidity, and I want to make sure I get paid. So I own some treasuries. But it's interesting to watch them lose control of the long end of the curve. And I think despite their best efforts through at things like moral suasion and direct on-market operations, that they are losing control of the long end of the curve, and they're losing it to the market. You know, Andy, it's great that you mentioned the 10-year treasury, and you and I have had this discussion. If you believe that the CPI is an accurate measure of inflation, then the yield on the 10-year treasury represents adequate real return to investors. Make no mistake, they will pay you because they can print it. If you were receiving 4.5% against a currency that was devaluing at 2.5%, you'd get a 2% real yield, which riskless is not a bad thing. I dispute that CPI number. I'm no economist, but I do keep track of my expenditures. I'm an old fat cheapskate, you know? And when I look at the basket of goods and services that I consume, I think that the deterioration of the purchasing power of my savings is at more like 7.5%. John Williams from Shadow Stats would tell you 12%. But I think it's more like 7.5%. So the value proposition around the U.S. 10-year Treasury for me is that they pay me 4.5 in a currency that's devaluing at 7.5, meaning they cost me 3% of my wealth a year, every year for 10 years. Risk-free return, as Jim Grant would say. You know, the other interesting thing about the CPI, and sort of harp on this, but people need to get it. The CPI, Consumer Price Index, doesn't include tax. The largest single living expense for most American households is tax. Now, you know me well enough to know, Andy, if I didn't have to pay the tax, I probably wouldn't bitch quite so much about the index. But that's not on offer. And it's important for your listeners to recognize, on the one hand, $130 trillion in liabilities, which is to say the credit quality of the debtor is not as good as you might believe. And at the same time, to realize that real interest rates are decidedly negative. I just, by the way, gave your listeners the gold thesis.
To understand how we arrived at this critical moment, we need to rewind the tape and look at the economic storm quietly building for decades. In the 1970s, the dollar faced a brutal reckoning, devalued by over 70% in less than a decade. As inflation soared, wages stagnated, and gold was unleashed from its $35 tether. But the difference now? The scale. Back then, America had debt. Today, it has a fiscal time bomb. $130 trillion in unfunded liabilities, Social Security obligations, Medicare promises, and more IOUs than any economy in history could ever hope to honor. And while the Federal Reserve postures about controlling inflation, the numbers don't lie. Real interest rates, what you get when you subtract inflation from the Fed's target, are negative by as much as 3% to 5% depending on who you ask. Official inflation might be 2.3%, but real-world prices tell another story. Ask the average family at the grocery store or at the gas pump. Ask the builder dealing with raw material costs. Inflation is back, but it's hidden behind doctored metrics, and that deception has consequences. Because here's what this economic setup creates: a perfect storm. A central bank trapped between raising rates into a dead iceberg or slashing them and stoking hyperinflation. A dollar that no longer feels safe. And a public that's starting to remember what real money feels like. Tangible, finite, incorruptible. That's where silver re-enters the conversation. Because unlike fiat, silver can't be conjured from nothing. And unlike digital debt instruments, silver doesn't default. We've been here before. But this time, the bubble is bigger, the policy options are fewer, and the exit doors are smaller. And investors, especially outside the West, are starting to sprint for the exits.
Yeah, I've sold my gold on occasion. Not all of it. I've always kept some. But to me, gold is a few things. It's insurance. It's liquidity, because I am willing to sell it if something better comes along. And it's interesting, you asked the question, what would make me sell gold? I was addressing my own audience at the Rural Classroom a couple weeks ago. And I told people that I expect the decade coming up to resemble, in some senses, the decade of the 1970s. I expect that the purchasing power of the US dollar will decline by about 75% over 10 years, which is what happened in the 1970s. And I think that the rise of gold will more or less maintain your real purchasing power in US dollars. If that happens, it makes absolute sense that if the purchasing power of the US dollar over 10 years declines by 75%, that the price of gold will increase threefold or fourfold. In the decade of the 1970s, with the purchasing power of the US dollar declining by 75%, the gold price ran 30-fold. Now, important to understand that probably the move from $35 to $100 between 1970 and 1973 had to do with removal of the price cap and allowing people to buy gold, because the London price of gold was higher than the US price of gold. And I would argue that the move from 500 to 850 was reversion past mean, which is to say investors were piling on to gold. But that move from $100 to $500 is, I suspect, all a function of the deterioration of the purchasing power of the US dollar. It's past its prologue, and it won't be exact. My suspicion is that my purchasing power will decline by 75%, and the gold price will keep me whole in nominal terms.
The BRICS nations, Brazil, Russia, India, China, and South Africa, are no longer whispering about de-dollarization. They're executing it in real time. Over the last 18 months, we've witnessed a quiet but powerful rebellion as these economies reduce their U.S. Treasury holdings, settle more trade in local currencies, and begin stockpiling gold and, increasingly, silver. What used to be theoretical strategic diversification is now a direct challenge to U.S. monetary dominance. China has led the charge, cutting its exposure to U.S. debt while signing bilateral trade deals denominated in yuan. Russia, already locked out of the SWIFT system, has no use for the dollar and is trading energy for gold and rubles. Even India, traditionally more cautious, is now engaging in rupee-ruble oil trades. The entire BRICS bloc is building alternative payment systems, setting up currency swap lines, and exploring gold-backed digital currencies. The goal is clear: displace the dollar as the global reserve. And here's where silver enters the equation, not just as an industrial metal, but as monetary insurance. These countries know the playbook. When trust in paper vanishes, the world turns to hard assets. And while gold gets the headlines, silver is the sleeper. It's far more affordable, historically linked to currency systems, and currently undervalued based on the gold to silver ratio sitting near 100:1. Petit, more than double its historical average. The BRICS aren't just preparing for a new financial architecture, they're actively building it, brick by brick, asset by asset. As they dump dollars and accumulate real stores of value, silver's role is expanding from commodity to currency proxy. And the implications of that shift, they haven't even begun to be priced in.
I was a pretty hard worker. I emigrated from the United States to Canada if my memory serves me well, 1970. I went to the University of British Columbia because they had the only degree program in North America focused on natural resource finance. My parents disagreed with that decision, and one consequence of that is that I had to finance my own education, which meant I had to hustle for any kind of job I could get. I worked on tugboats. I worked up in the Arctic on a dredge. I worked setting chokers logging. I was a bouncer. With my pickup truck, I cleared junk and gardens and stuff on weekends. I kind of hustled and did it all. I'm delighted I'm not in that position anymore, and I am very grateful that I did all those things. I had really a wonderful time as a young man. I met a lot of great people. Everybody should come up hard scrabble, I think. I think some of both. On the face of it, what we're heading into reminds me a lot of the decade of the 1970s. I think that the gradual devaluation in the purchasing power of the U.S. dollar is an inevitability, and I think it's begun. That's very similar to the 1970s. The Office of Management and Budget said in the 1970s, the U.S. dollar lost 75% of its purchasing power, not against other currencies, but over that decade, what would have cost you $250 in 1970 would have cost you $1,000 in 1980. And I think we're coming into that. I think there are two other factors that investors need to consider when they think about that. One is good and one is bad. The good one is that we have enormously better technology now. Enormously better technology. And human advancement and advances in efficiency will be driven as much by technology.
Silver's role as money is nothing new. It's been used in coinage and trade for thousands of years. But after decades in the shadow of gold, something's shifting. As trust in fiat currencies erodes and BRICS nations move toward asset-backed systems, silver is being reevaluated not just as an industrial metal, but as monetary ballast. Let's look at the numbers. The gold-to-silver ratio currently hovers near 100.1. Historically, that ratio has averaged around 40 to 60. Every time the gap has stretched this wide, it's snapped back, and when it does, silver doesn't just play catch-up, it erupts. In the 1970s, that ratio collapsed from over 80 to below 20, sparking a silver super spike. In 2011, it fell from 70 to 30, driving silver up nearly 400%. And right now, the fundamentals are lining up for another reversion. Only this time, the global financial system is in far worse shape. Central banks are hoarding gold at record levels. But here's the catch. They're not the only ones waking up. Sovereign wealth funds, pension managers, and high net worth investors are quietly increasing allocations to silver through physical bars, ETFs, and mining stocks. Why? Because silver, unlike fiat currencies or even some digital assets, has no counterparty risk. It can't be inflated, hacked, or sanctioned. Silver is money. It always has been. And in a world where digital fiat experiments are failing and trust in traditional monetary systems is collapsing, it's being rediscovered by those who understand that wealth preservation means owning something real. As capital flees paper promises, silver's return to monetary prominence is no longer a theory. It's a trend, and it's accelerating.
From recycling and byproduct production from other metals. So it's damned hard to build a silver company. The second is the perception of political risk. If you're going to be in the silver mining business and be successful, you are going to be in Peru, or you're going to be in Mexico, or you're going to be in the far east of Russia, mostly. And those are not easy jurisdictions. There are some contrary examples, but particularly during periods of time with political instability in Peru and Mexico, which is most of the time, raising capital is constrained. There are silver deposits in other parts of the world, but on a project basis, it's very difficult, with a couple of exceptions, for those deposits to compete with Peru, Mexico, and the far east of Russia. Over the course of a decade, one might experience 2 or 3 extraordinarily good years in the silver business. I mean, extraordinarily good years, ripping years. But then one often suffers through 6 or 7 or 8 years that are lackluster at best. If you are a company executive and you're forced to raise equity to keep your company alive during those bad years, particularly in the not unlikely event that something is going wrong in Peru and Mexico.
Now let's talk about the elephant in the vault. Physical silver is running dry. We're not talking about a temporary dip in supply. We're looking at a structural, multi-year deficit that's cracking the foundation of the entire market. For the 5th year in a row, silver demand is outpacing supply. In 2025 alone, we're facing a forecasted shortfall of 149 million ounces. That's not just a shortage. That's a crisis in slow motion. Mining production is struggling to keep pace. Even with a 2% year-over-year increase, output from primary silver mines remains flat or declining, with the biggest hits coming from regions like Peru, where political instability and funding constraints are halting expansion. Meanwhile, above-ground inventories are being depleted just to keep the market functioning. Recycling has ticked up, yes, but even at its highest levels since 2012, it's barely a band-aid on a hemorrhaging wound. So where is all the silver going? A growing chunk is disappearing into long-term vaults, ETFs, sovereign reserves, and private investment hoards. But here's what's even more alarming. Coin and bar demand has surged 7% in 2025 after a sharp drop last year. Investors are waking up, and they're not buying futures contracts. They want the metal in hand. And when they go looking for it, they're finding delays, inflated premiums, and in some cases, no product at all. Dealers are stretched, refiners are maxed out, and the flow of silver from mines to mints is getting choked by logistical bottlenecks and rising costs. If the deficit continues, and every sign says it will, the day is coming when there simply won't be enough physical silver to go around. And when that happens, price isn't just going up, it's going vertical.
Is capital. The market that we saw in 1970 was very, very different. Advancement was very, very capital intensive, much less technology intensive. And even in the United States, or perhaps I should say particularly in the United States, despite some bad aspects of our culture, we still are a place where 6 kids can take over a garage in Sunnyvale and out pops Google or out pops Apple, making billionaires, but also making life more efficient for lots of people. So that's a very, very good thing. A very good thing. I'm tempted to say that for the last 40 years, our individual ingenuity and tenacity has funded our collective stupidity. Now let's move on to that collective stupidity. At the beginning of the decade of the 1970s, the unfunded entitlement liabilities, the off-balance sheet liabilities of the U.S. government, were effectively zero. We had a very young demographic. The baby boomers, you and I, were just coming of age. So there was a lot of employed workers looking after a very few beneficiaries. Today, the net present value of unfunded liabilities, according to the Congressional Budget Office, not some old crank named Rick Rule, is $100 trillion. That's a very different number. To put it in perspective, gross federal revenues before any expenditure is $5 trillion. And the net present value, not the nominal value, the net present value of unfunded entitlement liabilities is $100 trillion. In 1970, as we were entering into this epoch of devaluation, on-balance sheet liabilities of the federal government were between 25 and 30% of GDP. Now, on-balance sheet liabilities, which is to say the money that we owe the bondholders, exceeds 120% of GDP. So if we have a circumstance where the challenges are similar, and I think that's where we are, the difficulty that we have is that we have already stretched the rope much thinner than we did in the decade of the 1970s. Make no mistake, Andy, you know and I know that we're going to get through this. but it's going to be a lot harder than it was in the period 1982 to 2022. That 40-year epoch where the dollar reigned supreme, where we could export inflation to our, quote, allies, where real and nominal interest rates were falling, where the wind was at our back, that's over. And we're coming into times that are much more challenging times. I hope all of your listeners, but especially your young listeners, understand that the time where the wind was truly at your back and the time when you could plan your future based on Medicare, Medicaid, Social Security, all that kind of stuff, that's over. You got to rely on yourself. And that would be my most important answer to that question.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. The industrial machine that's chewing through silver is only getting louder and hungrier. This isn't some distant future forecast. It's happening now, in real time, and it's setting the stage for a demand shock unlike anything the market has ever seen. Silver isn't just a monetary hedge anymore. It's the heartbeat of modern industry, and the numbers don't lie. Let's start with solar. Each gigawatt of solar capacity requires roughly 1,000 kilograms of silver, and with the world adding hundreds of gigawatts annually, demand from the photovoltaic sector alone is expected to reach as high as 261 million ounces this year. That's nearly a quarter of global silver supply, devoured by just one sector, and it's not slowing down. Countries are doubling down on net zero targets, funneling billions into solar infrastructure, and silver is the irreplaceable ingredient making it all work. Now, layer on electric vehicles. Each EV uses between 25 and 50 grams of silver, almost double what internal combustion engines require. Add in the explosion of 350 kilobus fast chargers, each needing half a kilogram of silver, and the pressure on supply becomes overwhelming. EV production is expected to triple by the end of the decade, and with it, silver demand will skyrocket. Then there's electronics. Every smartphone, every server, every inch of 5G infrastructure is wired with silver. Semiconductors are consuming more silver per unit than ever before, and that demand is growing at 6% annually. In fact, industrial applications already account for more than 80% of mine output, a staggering jump from the 51% share they held just a decade ago. This isn't just a trend, it's a transformation. Silver is no longer just sitting in vaults. It's being soldered, wired, and fused into the very fabric of our future. And here's the catch. Once it's used, most of it can't be economically recovered. It's gone, locked away in devices, cars, and infrastructure. And that's where the real supply crisis begins, not at the mint, but on the factory floor.
What would cause me to sell gold? Now I'll answer your question just for fun, Andy. If the reasons to own gold went away, specifically, if we saw a balanced U.S. budget. A balanced budget in real terms, not where the savings come in the out years and the expenditures occur this year. So I'd have to see a balanced U.S. budget. I would also have to see a fiscally responsible, politically acceptable solution to entitlements. I would have to understand how we funded $100 trillion in net present value of entitlement liabilities. I would also have to see, by the way, I'd settled for 2 out of 3. I would also have to see positive real interest rates. In other words, I would have to see the yield on the 10-year Treasury exceed by 150 or 200 basis points the underlying rate of deterioration of the U.S. dollar, which is to say, rather than seeing a U.S. 10-year Treasury at 4.5, currently I'd have to see a U.S. 10-year Treasury at 9. And just for fun, I think it's also worthy to note that the market share of precious metals and precious metals related investment products is about 0.5% right now, which is to say, if you look at the total value of savings and investment assets in the United States market, the market share of precious metals and precious metals related securities is about 0.5%. The 4-decade mean, according to JP Morgan Chase, is 2%. So I would probably also, before I sold gold, have to see the market share of precious metals relative to other savings and investment assets in the United States revert to mean. Those 4 things would cause me to sell gold. The only other thing that would cause me to sell gold would be such a dramatic undervaluation in some asset class that I understood that I could see some other place to maintain my purchasing power that exceeded gold's ability to do so, and do so simply.
Behind the scenes of the silver market lies a ticking time bomb, and it's spelled COMEX. The paper silver market, dominated by futures contracts traded on the Comex exchange, has long been a playground for big institutions to suppress price movements through short positions. But that game is nearing its end, because when you peel back the data, what you find is a market stretched thin, where bullish speculation is rising, commercial hedging is maxed out, and physical redemption could trigger chaos. As of May 2025, large speculators, hedge funds, money managers, and momentum traders are holding nearly 71,000 long contracts against just 20,000 shorts. That's a net long of over 50,000 contracts. Meanwhile, the commercial side, the banks and producers, are stacked 3-1 on the short side, betting against silver even as prices climb. This isn't just normal market positioning. This is a pressure cooker of opposing forces. Speculators betting on the breakout, commercials trying to keep a lid on it. The net long interest has surged almost 3,000 contracts in just weeks. Open interest is climbing, and with physical silver becoming scarce, the risk of a run on Comex inventories becomes very real. Because here's the secret most retail investors don't know. Only a tiny fraction of those futures contracts are backed by actual silver. The rest? Paper promises. If enough investors start demanding physical delivery, especially during a panic buying phase triggered by a price spike or currency event, the Comex could be exposed for what it really is, a leveraged shell game. And when that happens, the shorts won't just be squeezed. They'll be crushed. The signs are already flashing red. Exchange-traded products soaked up over 60 million ounces last year, with forecasts pointing to 70 million this year. The smart money is shifting out of paper and into metal. And if retail joins that wave en masse, the Comex won't have the metal to deliver. The short squeeze isn't a possibility. It's a powder keg waiting for a match.
It absolutely does. By the way, I take a different view of political risk. I understand it. I've experienced it. But the biggest risks in my life have been technical risks, which is to say project failure. I still prefer to have a project that's worth the government stealing than to have a project that's immune from government theft because it's a lousy project. And so I start with the project before I assess the risk. But I have to say that areas that are perceived to be riskless are often high risk. As an example, the worst monetary effect of political risk in my portfolio ever occurred in 1980 in the People's Republic of California. We made a discovery, unfortunately, 7 miles on the wrong side of the California-Nevada line. And permitting took 13 years and $16 million in bribes, not efficient bribes, but rather campaign contributions, deeds in lieu. You think about the net present value of revenue that's 13 years delayed. That political risk exposed Viceroy shareholders to about $600 million in aggregate losses over 13 years. And people tell me that Congo is risky. In free enterprise jurisdictions, as an example, the province of Alberta, I remember 20 years when the natural gas price went up, and the provincial government retroactively tripled the royalty. Tripled. So I would suggest that particularly investors who look like you and I discount political risk when it occurs in English according to the rule of law by white people. But I've experienced political risks from all sorts of races and religions, and I can tell you that money that's stolen, irrespective of whether it's stolen efficiently in Africa or inefficiently by democratic processes in North America, is just as...
If there's one illusion propping up this entire charade, it's the lie of low inflation. The official number as of April 2025 is 2.3%. Sounds tame, even healthy. But the reality on the ground tells a different story. Prices for housing, food, energy, and raw materials have been rising far faster than government reports admit. Shadow stats and independent metrics put real inflation closer to 7.5%, and that difference changes everything. Why does this matter for silver? Because inflation isn't just about what you pay at the store. It determines interest rates, currency strength, and investor behavior. When inflation is understated, the illusion of positive real rates is maintained. The Fed points to its 4.33% benchmark and claims victory over inflation. But if real inflation is double or triple what's reported, then real interest rates are deeply negative. That's the kind of environment where fiat currencies historically collapse, and hard assets like silver thrive. This misrepresentation allows central banks to maintain the illusion of control while quietly inflating away their debt. But as more investors wake up to the gap between real and reported inflation, their confidence in fiat money and in the central banks themselves starts to erode. And when that erosion begins, the flight to tangible assets accelerates. Silver becomes more than just a hedge. It becomes a necessity, not just because it retains value, but because it's outside the system. It's not diluted by policy decisions, not distorted by inflation reports, and not devalued by political games. And unlike digital assets or equities, silver is immune to algorithmic manipulation and stock buybacks. It's the cleanest form of wealth preservation in a world built on financial distortion. So while the mainstream media pats the Fed on the back, savvy investors are stacking silver, not because they fear inflation, but because they see through the smoke. The real question now isn't whether inflation is under control. It's how much longer they can keep pretending it is.
Investors' feelings, my own included. But that turned around last year. The increase in the gold price continued, while the input costs around skilled labor and energy in particular, but also fabricated products, steel, cement, declined. And the mining industry margins first expanded and then exploded. The money, when it comes into gold equities, comes into the best of the best first. This happens for two reasons. Gold industry investors are risk averse, so although they like the thesis, they don't want to take the risk inherent to the juniors. And when generalist investors comes into the space, they come into the biggest and the best, particularly the passive investors, the ETFs. And we've seen over the last year the best of the best, the biggest, with share price escalations of 60%, 70%, 100% in some cases. These markets, as I say, follow a predictable pattern. So as the best of the best become more expensive relative to their peers and enjoy a lower cost of capital, that situation resolves itself either through value arbitrage, people like me looking lower in the food chain and seeing things that are relatively cheaper and bidding them up, or it changes because there's takeovers. Big companies take over little companies. But at any rate, after the biggest and the best have moved, the best of the rest moves. After the best of the rest have moved, the bull market comes down into the developers, and after that, into the explorers. Visualize it the way you visualize a circus master's whip. The handle and the front of the whip is the metal itself. It moves first. The biggest and the best are a quarter of the way through the whip. They move after the front of the whip, but they move further and they move faster. Then comes the best of the rest. The middle of the whip comes after the first quarter of the whip, but it moves further and eventually it moves faster. And then finally, the exploration companies, high quality exploration companies, the end of the whip. But remember that bullish statement, and by the way, we're in this equities bull market. You don't have to wait for this one. It's here. Understand that only 10% of the listings worldwide are worth screwing with. So if you aren't willing to do the work to separate in movie parlance the good from the bad from the ugly, buy bullion and relax.
Trust, once lost, is nearly impossible to recover. And right now, trust in fiat currencies is unraveling at an alarming pace. From developed nations with ballooning deficits to emerging markets ditching the dollar for bilateral trade in gold and local currencies, the message is clear. Paper promises are losing their power. The foundations of the modern monetary system, faith in central banks, confidence in governments, belief in endless debt, are crumbling in plain sight. Let's be honest. People aren't just skeptical anymore. They're fed up. They're watching their savings eroded by stealth inflation. They're watching reckless spending with no fiscal accountability. And they're realizing that fiat currency isn't backed by anything but political will. And that will is fracturing. It's no longer just doom and gloom commentators saying this. It's mainstream investors. It's nations. It's markets. And when trust evaporates, capital flees. It runs toward scarcity, toward tangibility, toward anything that can't be printed or frozen or defaulted on. Gold is the traditional safe haven, but silver is the one that catches fire. Why? Because silver is accessible. It's liquid. It's overlooked. And that makes it dangerous for the system once the stampede begins. What we're witnessing is the slow-motion collapse of a confidence game that's lasted half a century. Bretton Woods ended gold backing in 1971, and the world has been running on trust ever since. But trust isn't infinite, and once the spell breaks, the consequences are fast and violent. In that kind of environment, silver isn't just a hedge, it's a vote against corruption, a vote against central bank manipulation, and a vote for real, untouchable value. Every ounce bought is one less dollar trusted. And when millions start voting that way, the system doesn't bend, it breaks.
Probably 90% of the mining company shares listed worldwide are valueless. So when you talk about gold mining equities, all of the value is in 10% of the listings. If there are 3,000 companies worldwide that are nominally public and nominally in the mining business, probably 300 of them, 10% of the total number, are worth considering. So don't consider the sector as an asset class, because as an asset class, it's an absolute disaster. If you aren't willing to do the work to separate the wheat from the chaff, just buy physical gold and relax. I'm sure that is music to your ears, Andy. If you are willing to do the work, however, the sector is on fundamentals, on enterprise value versus net present value, as cheap as I've ever seen it. And importantly, the bull market is already underway. This will be my fourth bull market. The first one was in the decade of the 70s when I was too young and dumb to understand the first half of it. But the next two, I played reasonably well. And bull markets follow a very predictable pattern. It's led by the commodity, which almost always is revaluing from an oversold base, which gold certainly did. As I say, the market is led by the commodity before the equities. And this time that happened in spades, because market leadership wasn't from retail people, but rather from central banks. And central banks don't buy gold shares. So gold went up without the gold shares responding because there was a buyer for one asset class and there wasn't for another asset class. Traditionally, in precious metals bull markets, after the metal leads, two good things happen from an investment perspective. One, the increase in the metal price occurs faster than the costs associated with producing it. So the margins increase. At the beginning of this bull market in 2023, we didn't see that because input inflation, particularly energy, but also skilled labor, and most particularly social rents, taxes, and royalties, increased faster than the gold price. So although the gold price went up, the producer margins didn't go up and in some cases declined. That hurt investors.
Silver's price chart is beginning to look like a coiled spring, and the $35 threshold is the tension point. This isn't just a random resistance level. It's the line in the sand where technical momentum, psychological confidence, and institutional positioning collide. And once it breaks, we're not just looking at a slow grind higher. We're staring down the barrel of a vertical move. Here's why. Historically, silver's biggest rallies have been triggered by breaches of long-term resistance zones. In 2010, it took out the $20 level and doubled within months. In the late 70s, silver blasted through $10 and hit $50 like a runaway freight train. And today, $35 is the modern equivalent. It's the ceiling holding back a flood of sideline capital. ETFs, hedge funds, pension allocations, waiting for confirmation to pounce. And it's not just technicals. This breakout point aligns with a psychological shift. At $35, silver will have retraced to levels not seen since the early 2010s. That signals to the market that the decade-long suppression is over, that silver's time as a sleepy commodity is done, and that the new era of real asset demand has arrived. More importantly, the breakout would coincide with macro triggers already in motion: dollar devaluation, central bank pivoting, BRICS de-dollarization, and global supply chain fractures. It's a perfect storm of catalysts colliding at a single, visible price level, and once $35 breaks, price action becomes disorderly. Resistance evaporates. Buyers rush in, shorts scramble to cover, momentum chasers pile on, and the market, once thought to be slow and predictable, becomes explosive. The chart won't move in inches, it'll move in leaps. And the next logical target, not $40, not $50. Think bigger, much bigger.
Rather than sensible businesses. I absolutely have to be a contrarian. I have to buy when things are deeply out of favor. I learned something, though, from our mutual friend, Steve Sugarrood. Steve Sugarrood said, Rick, you're partly wrong. If you're as early as you often are at an 8% discount, you're partly wrong. You have to find something that is out of favor, unknown, cheap, and in an uptrend.
Well, that doesn't sound very easy.
That is a really interesting discussion when you overlay that on the gold market. I was saying the same things I'm saying today in 2021 and 2022, but I didn't get any particular joy, at least in the gold stocks, until 2024. What has changed over time is that my thesis has begun to be proven. The stuff is still cheap, but it's in an uptrend. You obviate now the time value of money objection to the thesis.
So what would it take for silver to hit $500? Not a miracle, just a cascade of events already set in motion. Once that $30 barrier is shattered, the chain reaction begins. First comes the technical breakout, triggering a rush of capital from institutions and funds that have been sitting on the sidelines. Algorithms light up. Retail investors take notice. The media finally starts paying attention. And suddenly, silver is on everyone's radar. As demand surges, the physical shortage kicks in. Mints can't keep up. Bullion dealers run dry. Premiums skyrocket. And the disconnect between paper and physical markets becomes undeniable. Investors lose faith in futures contracts and chase the real thing, just as Comex inventories shrink and redemptions rise. And then comes the panic, the moment when people realize silver isn't just going up in price. It's disappearing. That's when FOMO kicks in. Retail investors flood the market. Sovereign funds scramble to diversify out of fiat. And institutions, fearing they've missed the bottom, begin overbidding to secure supply. Silver mining stocks go parabolic. Junior miners post triple-digit gains. And everyone starts recalculating what fair value actually means in a world where trust in paper assets has collapsed. Remember, the supply of silver isn't elastic. Mines can't suddenly double output. Recycling hits a wall, and with industrial demand locking away more ounces every year, the float shrinks just as the buying frenzy accelerates. It's a classic supply squeeze, with a monetary twist. Under those conditions, $50 isn't a ceiling, it's the ignition point. $100 becomes the checkpoint. And $500, it's not a wild forecast. It's the result of global capital rushing into a tiny, undervalued market as the old system breaks and a new one demands real, tangible wealth.
I would agree with that, with the caveat that I've studied the silver market for 50 years and I still don't understand it. In oil and gas, I understand the why. And in silver, I don't. But that's okay, because I have a very good memory. And we described earlier the anatomy of a precious metals bull market. The leadership in a precious metals bull market is always gold. But when gold's momentum attracts the generalist investor, and the generalist investor comes down into the precious metal space, perhaps it's because of the lower unit cost of silver. Perhaps it's because of its reputation for upside volatility. Perhaps it's both. But at some point in time, leadership changes from gold to silver. When that happens, you will not need Rick Rule to tell you it's occurring. It will be dramatically obvious. And silver moves much further and much faster than gold does. I don't own silver in an investment portfolio, but I do own silver in my speculative portfolios. And I do it because of history. When I look back to the decade of the 1970s, silver moved from $1.30 to $50. But some of the silver stocks did even better. My reference stock was Coeur d'Alene, which moved from 10 cents to $65. Not a typo. Now, I was too young and dumb and poor to take advantage of that, but you better believe it got my attention. Early in the 1990s, we had a wonderful metals bull market that many people, well, people younger than me didn't experience, but others don't remember. And silver moved from about $4 an ounce again to $50 an ounce. Now, I was by then ready to take advantage. And we helped establish two silver mining companies then, Silver Standard Resources and Pan American Silver. One started at 50 cents, the other started at 72 cents. Both peaked 6 years later at $45. And it's odd having experienced that, and then having experienced, of course, that wonderful bull market from 2000 to 2011. It's no surprise that I'm attracted to the silver and silver equities market. Make no mistake, most of my bullion, 95% of my bullion, is gold. Because I own bullion to sleep nights and stay calm. I own it for insurance. But I do have a physical silver component in my portfolio, some of which I forgot to sell from last bull market. And I have a reasonable position in the silver stocks. I don't know when market leadership is going to change from gold to silver. What I do know is, quoting our mutual friend Doug Casey, when the generalist investor comes down into the silver equities, there are so few of them, and their combined market cap is so minuscule.
If the dollar does collapse, and all signs point to that moment drawing closer, then silver isn't just going to rise. It's going to redefine wealth for an entire generation. In a world where fiat currencies falter, where trust in central banks disintegrates, and where digital systems prove fragile, physical silver stands as one of the few assets left with real, immutable value. Rick Rule's warning wasn't hyperbole, it was a roadmap. A 75% devaluation of the dollar, BRICS nations abandoning the greenback, industrial demand soaring, supply collapsing, and paper markets pushed to the brink. These aren't isolated events. They're all pieces of the same puzzle, a puzzle that leads to one outcome, a global monetary reset centered around tangible assets. And silver, with its dual role as industrial workhorse and monetary rebel, is positioned to explode. The truth is, by the time the mainstream catches on, the window will have already closed. The price won't climb in steps. It will leap in waves. $35 becomes $100 overnight, then $250. And in the chaos, while paper wealth evaporates, those holding physical silver will be the ones who emerge not just intact, but empowered. If you're still watching, now's the time to ask yourself, are you holding real assets or just promises? Because when the system resets, it won't be paper that buys your future, it'll be what's in your vault. Make sure you're subscribed so you don't miss what's coming next. And remember, this is not financial advice. Always speak with a qualified professional before making any financial decisions.